Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Koss Corporation stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Koss designs and manufactures headphones and audio accessories. It is located in Milwaukee, Wisconsin. The company started in 1958. It invented the first high-fidelity stereo phones. Let's get started with the model. This is a micro-cap company, 267 million market cap. They're trading at 35 a share, and they have 7 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has about $1 million of free cash flow each year, a little less in the trailing 12 months. Net income is a profit and loss on the income statement. It's revenue minus expenses. They had negative $3 million in 2018. This spreadsheet rounds to the nearest million, so it rounds to zero for 2019, 2020 in the trailing 12 months. Revenue is sales for the company, and that's pretty steady from $24 million to $20 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference is the gross profit. They do have positive gross profit every year, between $5.5 and $7 million. Below that is operating expenses. And they have negative operating income every year except in 2019. They also have interest on their debt, and they don't have much in other income and expenses. The bottom line of the income statement is their net income, and that's negative every year except in 2019. That was positive $434,000. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive free cash flow every year. Free cash flow is the cash that you can use to pay down debt, to pay a dividend, to buy back stock, or to invest back into your business. The company did issue $500,000 of debt in 2020. The most important part of any business is our operating cash flow, and this company does have positive operating cash flow each year. To calculate that, you start with net income, that was negative $237,000. Then you have to add back the depreciation, that was $370,000. They also had $400,000 stock-based compensation, then a bunch of other items. So even though they reported negative $237,000 of profit, they actually generated $400,000 of cash flow. Let's look at a capital structure. They have $15 million of equity, $3 million of debt. So they're 83% equity, 17% debt. Their net debt is negative $1 million. That means they could pay off all the debt with the cash on their balance sheet and still have $1 million left over. Their WACC is 12.25%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows. Past year 4, that's $40 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $30 million. We divide that by 7 million shares. And we get a calculated stock price of $4. They're trading at $35, so they're trading at a significant premium. It's a sell according to the model. Simply Wall Street values the company at $5, so they're a little higher than me, but they're also saying the stock is overvalued. The stock was trading between $0 and $3 for many years, but the past week it really shot up. The stock price was over $100 at one point. Lots of retail investors were buying stocks like GameStop and AMC Theaters. They were trying to apply a short squeeze on the hedge funds. This stock is not shorted, but for some reason this stock got caught up in the madness and a lot of people started buying this company as well. The market cap was only $14 million a couple of weeks ago. Then it hit $500 million. This company has a beta of 1.34, so the stock moves a little more than the market. The stock has gone up over 4,000% in the past 52 weeks. The S&P 500 went up only 14% in the same time frame. The low was 80 cents, the high was 127, and the stock is trading well above its 50-day and 200-day moving average. About 15 million shares are traded each day for this stock in the past 10 days. Of the 7.4 million shares outstanding, half of them are on float, and only 9% of the shares are held by institutions, and under 1% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you would have lost almost all your money if you sold last week, but if you held out, you could have sold for $125,000. The owner of the company, John Koss, owns 19%, then his family owns 14%, then a company called KFT Corp owns 13%, then the Koss Foundation 3%. The bottom company owns 2.8% of their stock. Let's look at the financial ratios. The average PE in the market's 11, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 12.8, so investors are paying $12.80 for $1 of revenue. Price to book is stock price over book value per share. They're at 17.1. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 15 million of equity. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities. And their current assets are $4 million of cash, $2.3 million of receivables, and $5.5 million of inventory. The company does seem to be well funded. They did have positive free cash flow. They have almost $10 million of working capital, and they don't pay a dividend. The only other company I did in the same industry is Apple. Apple happens to be the biggest company in the world. Apple's doing better in PE and price to sales. Koss has a better price to book. Koss has a much higher current ratio. Apple has a great ROE. Koss is negative. Koss is only 17% debt. Apple is 63%. And Koss's market cap is a rounding error for Apple. And Koss does not pay a dividend. Apple does. So to summarize, I have them trading at a pretty significant premium. I rank their free cash flows 1 out of 10 because they don't have much coming in. I rank their revenue 1 out of 10 because it's really small and not growing. And I rank their ratios 1 out of 10 because they're pretty weak. So obviously this stock is going to come down in price. It was just inflated with all this craziness going on. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.